My work around concentrated equity ownership structures started in law school during a dissertation that I completed. When you looked at who the largest companies in the world were at the time, they largely fell within what's called the separation between ownership and control. They were essentially employee-managed companies. And there were these other companies that were doing very interesting things that fell within a different kind of ownership structure. And we call that founder centrism. Founder-centered companies are companies that are run by founders, or what we consider to be legacy founders. So essentially leaders with a long-term mindset, with a longer-term vision. When you look at the corporate governance theories that dominate, and at least when I did 10 years ago, they didn't seem to apply. And so as a result, during my dissertation, I developed a third theory of corporate governance. And that's, I recently shared this research with the University of Oxford, and the broad concept is concentrated equity ownership theory. And so what it does is it looks at ownership structure, and then there are other implications that flow once you drill down in terms of who owns the company, what is the level of deference the shareholder collective has towards the people that are running the company, and really the dominant question is the company situated for long-term growth? So my academic work looks at the ownership structures of companies and asks the question of, do they fall within a corporate governance framework that will incentivize management to act in the best interests of the corporation broadly defined? So that includes the entire shareholder collective and other stakeholder communities. So in terms of background, you have shareholder primacy. And the theory of shareholder primacy is that if the board of directors and senior management focus on what's in the best interest of the shareholders, which tends to be a pecuniary focus, a monetary focus, then everyone else will benefit. And that's been proven to be somewhat deficient. It doesn't explain the full picture. The other theory that really developed over the last 20 years is referred to as stakeholder theory. And that says that the board of directors and management should focus on a broad set of stakeholders. And if they do that, then all parties will benefit and the corporation will perform well. My research drills down a lot deeper, and it says, well, wait a minute here. In 1932, Burley and Means published their transformational work. It's a book on the separation between ownership and control. And the book is called The Modern Corporation and Private Property. And what they did was they looked at the ownership structure of companies trading in the public markets at the time. And they identified that there was a separation between who was running the company and who owned it, right? Who the shareholders were. In these kinds of structures, you have an issue called agency costs. The work of Michael Jensen out of Harvard in the late 1970s really identified agency costs, popularized it, and then private equity and Wall Street took that theory and ran with it. And so we now have in corporate governance structures that we take for granted as being consistent with best practices. But those really developed as a result of this issue of agency costs that came up the pipeline in academia. And so we have things like equity compensation. The purpose of equity compensation was to align the interests of the broad collective of shareholders with those of the people that were running the company. And the belief was that if we incentivized management in a way that they would benefit financially similar to the shareholders, then they would be inclined to act in the best interest of the shareholders. Running with that, when you look at stakeholder theory looks at the alignment of interests from a different perspective, and it brings in, I would say, social policy goals, which are also very much appropriate. Through the lens of founder centrism, we look at this ownership structure and we ask, is the company aligned? And when you have, for example, a company that's run by a founder and there's majority control, that company will tend to not have agency costs. But there's a correlated economic problem that develops, and we call it discriminatory costs. The risk that the founder or the person that controls the company will act in a manner which is in their best interest, but not necessarily, those rewards won't necessarily be shared with the entire shareholder collective. And through this theory, we also look at social issues. And so the ESG movement is very informative here, because if a company concerns itself with social issues, with the values of the day, then it will be positioned for long-term success in comparison to a company that's focused on more quarterly performance. And so that's the broad framework that we use to think about corporate governance And Founder Centrism is a significant part of that. We see corporate governance as being essentially a broad umbrella with two elements to it. One is something that we call business governance, and that focuses on the alignment of interests, which goes back to the origins of corporate governance. The other is what we refer to as social governance. Social governance touches on more of the longer-term elements of what allows a company to perform in a manner in which it can outperform its competitors, its colleagues over time. Within the business governance framework, we're looking for this alignment of interests. We're looking to see that a founder or whoever it is that's in charge of the company is running it in a manner that benefits the entire stakeholder group. Through the corporate governance lens on the social governance side, we're looking to see whether or not the company is acting in a manner that's consistent with good values or the values of the day. Are they concerned with, are they cognizant of the social good, the public good? Because companies that are will tend to outperform over time as they pursue their financial goals. If they're cognizant of what we call social governance factors, they will tend to make decisions that across nonlinear growth patterns that benefit the company over time.